Okay, merchandising concerns. This is what we're headed into, the nuances of merchandising. Merchandising companies. What are they? What are they? What is a merchandising company or merchandising concern? Well, they are companies that buy a good at one price and sell it at another. So we've been looking at so far service companies versus merchandising versus manufacturing. Manufacturers, they actually manufacture, they make the product that they sell. But in this chapter, we're looking at merchandising. And what is a merchandiser? A merchandiser is a company that buys a good at one price and sells it for another. They are all over the place. MC Sports, Home Depot, Staples, Sam's Club, the Gap, any kind of a clothing store, retail, big box companies, big box stores, right? Retail. These are the malls, right? The merchandising companies. Not just the malls, but this is what a merchandising company is. So what are they? And then another question would be, what are, that's an R. Let me get rid of that. My handwriting is bad. I'm using a new tablet, but there's no excuse for that. What are the nuances or differences for accounting when we're dealing with merchandisers, right? Merchandising company concern. Well, the two big differences are this. Remember always that assets equals liabilities plus owner's equity, and that owner's equity is impacted by revenues and expenses, right? Nothing's ever going to change here. Equals net income. What are the big nuances or differences? There's two of them. One is inventory. Suddenly, we've introduced a concept, not a concept, a reality of inventory. These goods, right? The goods that the company is selling. They buy them at one price, right? Store them, put them out on the floor. They sell them at another price, and they mark them up, right? Well, all of a sudden now we have something that we did not have for a service company. We have inventory. And inventory shows up on our asset. In our assets. We have this asset now called inventory that we have to account for. And we learned earlier in the last chapter that inventory is a current asset. Remember cash, marketable CMRIP, inventory shows up right there. Inventory is huge because it is for most companies the largest of all their current assets. So how we account for inventory, what we do with inventory matters a lot. So we're going to be looking at how do we handle inventory and accounting issues surrounding inventory. And the other thing we're going to look at, which is directly related to this, is over here under our expenses, we're now going to introduce an expense that we did not have in a service company. It's called cost of goods sold, or COGS, cost of goods sold. And we're going to see that a new expense, a new category of expense that we need to track and think about. And that is, what is the cost of the stuff that we're selling? It deals with inventory. I want you to see that these two are connected. The fact that we now have inventory coming in and going out means we also have a cost of goods sold. So we buy sneakers for $20 and we sell them for $60. What's our cost of goods sold? It's the $20 that we paid for those sneakers. We're selling them for $60, we're buying them for $20, and we're making $40. But this idea of cost of goods sold. So we're going to be looking at accounting and the accounting issues, nuances for merchandising companies that deals primarily in the category of inventory and cost of goods sold. So that's where we're headed in this chapter, accounting nuances for merchandising companies. See you in the next video.